now under 1 week until this year's tax filing deadline. For many filers, tax season comes with feelings of dread. My next guest says there are ways to future-proof your tax filing habits to avoid that last-minute scramble going forward. That is Lawrence Sprung, Midland Financial founder. He's joining me for this week's FA Corner, brought to you by Capital Group. And I think dread is a pretty common feeling, or procrastination, or just unease, whatever you want to call it. And obviously, tax filing deadline is next week, so there's only so much people can do at this point. But how should they be thinking about to avoid that feeling of dread?
Yeah, I think the important thing is setting themselves up for success so they don't feel that feeling of dread going forward. And there are certain things that they could be doing all year round. And unfortunately, January turns the corner and we all start turning, taxes are right around the corner. Start now. So start thinking about putting just a file.
Start now for next year.
Yeah, for next year's filing. Put together a filing folder, 2026, and as tax documents go in or you get receipts from charitable, start filling that folder so it's a little bit easier. You don't have to go searching. Start preparing now for tax season, and it'll take the burden off of next year. For sure.
So how do you think people should best get organized to do that? So you have a physical file, I guess, for physical stuff. You have a computer file for that stuff.
Yeah.
And then just do it regularly.
Yeah, and then from an investment standpoint, right, everybody scrambles in October and November. I got to do tax loss harvesting. Well, tax loss harvesting really should be an exercise that you look at all year long. There have been instances in the last few weeks where we've seen a bit of a downturn. That could have, for some folks, created an opportunity to take some losses now. So keep track of those capital gains and losses throughout the year. So if there is this type of downturn, perhaps you take advantage of it then rather than waiting till the end of the year.
How do you figure out what to itemize?
Yeah, so that's a decision that you really want to figure out early on, because whether you're going to itemize or take the standard deduction, because it's going to change some of those things that you're going to be able to do. You may want to, forward some of your charitable contributions this year. You may want to donate more. You may want to pay more of your property taxes instead of splitting it up. So that's something that earlier on in the year, I would say probably May or June, you should start leaning into whether or not it's going to look like you're going to itemize this year or not, and then plan accordingly.
What do you do if you do, we are coming up in the deadline, you have documents that you need.
Yeah.
How do you... Because I imagine that's some of the scramble for people.
Yeah, I think one of the biggest scrambles is from the investment perspective. Investment documents are coming out later and later.
Yes.
When I first started in the business, right at the end of January, those documents started coming out. Now, because some of these structures are more complicated, they're getting delayed. And then what you're seeing is people are getting 1099s and then they're getting corrected 1099s, sometimes multiple. So you really want to some degree, not file as early as you may think you want to. Because if you end up getting one of those corrective documents, you may have to do amended return, which is time and money, right? Yeah. So you might want to wait a little bit longer going forward.
And you talked about, sort of other things you can do in advance, tax diversification as well, kind of the different types of investments you have.
Yeah.
How do you need to think about those?
So what we're seeing now is a lot of people who are entering retirement, and largely because they did not have Roth IRAs or Roth 401ks early on in their career, they're very heavily in pre-tax money. And then what happens is they retire and they have these huge withdrawals, required minimum distribution. So start thinking about how you can effectively use putting away pre-tax money versus post, meaning Roth IRA and non-qualified money, because you don't want to be in a position where you're being forced to take out $50,000, $100,000 out of pre-tax money in retirement. It exacerbates your tax situation. So you want to be really mindful of that and thoughtful how you put that into place.
Yeah, there's a lot to think about. And obviously it helps to do it all early.
Yes.
Barry, thank you so much. It's good to see you. Appreciate it.